the financial world felt a distinct shudder. News emerged that China was significantly curtailing its investments. Wall Street, long accustomed to the inflow of Chinese capital, found itself abruptly facing a new reality. Analysts and traders scrambled to understand the full implications of this unexpected development. Firms that had spent years cultivating relationships in China were now confronted with a starkly different landscape. The decision from Beijing to reduce investment outflow sent a clear message. Questions arose about the stability of future projects and the viability of existing ventures. The flow of capital, once a predictable tide, now appeared subject to the unpredictable winds of international politics. This sudden change forced an immediate reassessment of risk and opportunity in the world's second-largest economy. The carefully constructed economic bridges between the East and West seemed to be under considerable strain. For Wall Street, the implications were manifold, extending beyond mere balance sheets. The interconnectedness of global markets meant that a significant policy shift in Beijing would inevitably send ripples across the Pacific. This development forced a rapid recalibration of expectations. President Trump's administration adopted a notably assertive stance on trade, particularly concerning China. His policies were explicitly designed to curtail what he perceived as unfair Chinese trade practices and to protect American industries. The imposition of substantial tariffs on Chinese goods became a cornerstone of this strategy. These measures were intended to rebalance the trade deficit and encourage a shift in manufacturing back to the United States. However, they also contributed to a climate of uncertainty and retaliation, directly influencing investment decisions on both sides of the Pacific. The announcement of sweeping tariffs in April 2025 sent immediate shockwaves through global markets. The scale of these tariffs was unprecedented, signaling a willingness to fundamentally alter the terms of trade with China. The policy shift created a volatile environment, making long-term planning exceptionally difficult for businesses reliant on stable U.S.-China trade. These policies directly contributed to the new U.S. rules for investing in Chinese companies, particularly those deemed potential national security risks. The heightened tensions and the unpredictable nature of tariff announcements made Wall Street increasingly cautious about its China exposure. This tariff doctrine played a crucial role in the decisions of Wall Street firms to scale back their China investments. In response to China's investment curtailment and the stringent new U.S. regulations, major Wall Street banks began a significant recalibration of their China strategies. Prominent institutions such as Goldman Sachs and Morgan Stanley found themselves at the forefront of this shift. These financial giants, which had previously viewed China as a key growth market, started to scale back their investments. The new U.S. rules, particularly those targeting Chinese companies perceived as national security threats, created a complex web of compliance challenges. The scaling back involved more than just reducing new investments, it also led to job cuts within their China-based operations. Wall Street executives were forced to make difficult choices, balancing the allure of potential profits against the escalating risks. The confusion following the mid-December 2024 meeting with U.S. Treasury officials highlighted the challenging tightrope these banks had to walk. The potential for sudden regulatory changes or further escalations in the trade war made long-term commitments to the Chinese market seem far riskier. This led to a more conservative approach, prioritizing risk management and compliance over aggressive expansion in the Chinese financial sector. The uncertainty surrounding the future of U.S. investment rules remained a significant concern. Section 4: Key players on a shifting stage: Xi, Bessent, and the diplomatic tightrope. President Xi Jinping's response to the evolving U.S. policies and the subsequent actions by Wall Street has been a critical element in this unfolding economic drama. The Chinese government has consistently advocated for global cooperation but has also demonstrated a resolve to protect its national interests and economic sovereignty. On the American side, U.S. Treasury Secretary Scott Bessent has been a central figure in navigating these turbulent waters. His role involves not only implementing U.S. policy, but also engaging in high-stakes negotiations with Chinese officials. The scheduled talks in Switzerland in late May or early June 2025 underscore the ongoing efforts to find some common ground amidst the tensions. Bessent has also been tasked with reassuring markets and international partners. The dynamic between President Trump's policy pronouncements and Secretary Bessent's diplomatic efforts has been complex. The effectiveness of Bessent's engagement with his Chinese counterparts will be crucial in determining the future trajectory of US-China economic relations. Section 5, Market Mayhem, Indices Tumble and Safe Haven Status questioned. The market's reaction to the escalating trade tensions and China's investment shifts has been one of significant volatility. President Trump's tariff announcement on April 2, 2025, triggered a sharp decline in major stock indices. The Dow Jones Industrial Average experienced a dramatic fall, plummeting nearly 1,000 points on one particularly turbulent day. Stocks, bonds, and the US dollar all fell simultaneously, a rare and worrying convergence that signaled deep investor unease. Even after a partial recovery, market sentiment remained fragile. The early weeks of May 2025 also saw Wall Street endure a volatile period, with the Dow, S&P 500, and Nasdaq all ending 1 week lower. A particularly concerning development has been the questioning of the United States' long-held status as a safe haven for global investors. The unpredictable nature of U.S. policy has led some to wonder if the U.S. financial system can maintain its reputation for stability and reliability. Analysts widely agree that confidence in the U.S. has taken a significant hit. Section 6. Economic shockwaves, global confidence and Federal Reserve anxieties. The repercussions of China's investment adjustments and the ongoing U.S.-China trade dispute extend far beyond Wall Street. The uncertainty generated by tariff battles and regulatory shifts makes businesses worldwide hesitant to commit to long-term capital expenditures. Federal Reserve officials have not remained silent amidst these developments. Figures such as Michael Barr and John Williams publicly warned in May 2025 about the potential negative consequences of President Trump's tariff policies. The Federal Reserve itself has found its independence challenged. The stability of monetary policy is a cornerstone of investor confidence. Section 7. The Uncertain Horizon, Charting the Future of US-China, Trade and Global Finance. The future outlook for US-China trade negotiations remains shrouded in considerable uncertainty. As banks and financial institutions await greater clarity on the new US investment rules, strategic planning becomes an exercise in navigating ambiguity. The mid-December 2024 meeting between Wall Street executives and US Treasury officials underscores the challenges in interpreting and implementing these new regulations. Continued tensions between Washington and Beijing could very well lead to even more stringent regulations. This would further impact Wall Street's ability to operate in China and could accelerate the trend of investment diversification away from the country. Analysts broadly concur that confidence in the United States as a predictable and stable economic partner has suffered a significant blow. The perception that the U.S. might be retreating from its traditional role as a champion of global free trade could have long-lasting consequences. The world is watching closely to see if stability can be restored. For Wall Street, it means adapting to a more fragmented and politicized global financial environment.